I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Ted Dixon, CEO and co-founder of IncResearch.ca, Canada's first online financial news and research service, providing insider news and knowledge to investors. Welcome back to the show, Ted.
It's great to be back, Jim.
After the G20 wrapped up in China, an interesting comment. Only 2 of the 20 leaders there actually have much of a mandate left. Justin Trudeau and, of course, the Chinese premiers and presidents serve as long as they want to, or unless they sort of get cooed out of business. Does that make a difference in their policies and how they approach what's happening in the world?
Absolutely. I think those looking to either remain in office or get in office have noticed the Trudeau Formula that promising infrastructure and delivering on infrastructure is a political win. And this is going to lead to a path of least resistance amongst the political class to start delivering more government spending where they can. And I say where they can because not every country will be able to do it, but there is a window, even in Europe, where the ECB is looking to consume as much government debt on its balance sheet as it seems to be able to get its hands on. And both the Hillary Clinton and Donald Trump are promising large infrastructure spending. So we seem to have this path of least resistance now that amongst the political elites, that spending on infrastructure is okay, whereas 3 or 4 years ago, everyone was talking balanced budgets, maintaining trying to get to balanced budgets anyways, maintaining the purse strings. And that was all well and good while central banks were able to juice things, but that game appears to be over.
Well, does this mean we're going to see projects like we saw in the dirty 30s, where, for example, in Regina, they have the Albert Street Bridge, which is the world's longest bridge over the narrowest body of water?
Well, I can only hope we do not see those types of projects and some of the famous projects you see in Japan. You've seen pictures of maybe that these bridges that literally end up in the side of a mountain. And so they do go to somewhere. They just happen to go against a flat rock surface. Hopefully countries will be a little bit more astute in terms of how they spend their dollars. But look, that's what's going to help separate the winners and the losers over the next generation, is countries that get it right and countries that get it wrong. And I don't think for a moment, by the way, that throwing all your money into infrastructure is necessarily the right policy prescription. But what I'm talking about is what will be the most politically viable amongst the political class. So in the United States, for example, no matter who wins, whether it's Clinton or Trump, they're still going to have to deal with a Congress. Well, Jim, how do you get your priorities through Congress if you're a president?
It seems almost impossible. It took Obama 6 years to get one budget through.
Right. So you have to do mega bribes. You have to promise pork. And with the narrative changing that infrastructure spending is okay, all of a sudden, you'll probably start to see some congressmen saying, "Oh, you know what? I'll take that bridge," or "Yeah, we could use another wing in our airport." And so the attitudes will start to shift, and eventually, you probably will see more government spending in larger countries, only because there's no other game left. Mohammed El-Arian, the former CEO of PIMCO, wrote a book this year called The Only Game in Town, Central Banks, Instability and Avoiding the Next Collapse, where he basically makes the case that, governments have been relying on central banks since the financial crisis to keep things going, but that game is at an end. Now it's up to actually the elected officials to come to the plate and say what they're going to do. And, he does not necessarily subscribe to infrastructure is the only option. But it really will be up to these politicians to come up with an agenda, and we will see. But infrastructure tends to be the easiest to swallow for most politicians, and then you can get down into sort of more of the R&D and innovation. But all of that then becomes complicated, and you don't see a payoff in that. You can't go to you can't sort of put an R&D grant in your flyer you send around to your constituents. But boy, if you get a new bridge, or if you get a new building that has seniors care, you can take a picture of that and send that around, and that's what politicians like. So the bottom line is we're probably going to see some more government spending, and it could start to pressure long-term interest rates, and that would be a real game changer. Now, we didn't see that happen in Japan. They threw millions and billions of yen and dollars at infrastructure, and the interest rates didn't go anywhere. However, the Japanese were able to self-fund all that government spending. In the United States, which really matters, they cannot. The savings rate, while it's gone up, is still fairly modest, and it can swing pretty quickly. So we would be looking at, I think, some real pressure put on the bond market. The Congressional Budget Office came out with a report in August indicating that for the first time since the financial crisis, the deficit to GDP ratio took a turn for the worse this year. And I can tell you that with all the Social Security spending that's on the books, that the outlook for the U.S. deficit is not getting any brighter. So I know there's a school of thought that says that doesn't matter. The bond rates are going to keep going down. We will see. We're starting to see signs that this whole central bank trade of lower rates and weaker currencies and lower, gold prices is over. And in 2016, we had this major, I would say, turn of events in January when the Bank of Japan tried to hammer the yen by going into negative rates, and what happened? The yen started to strengthen. So fast forward that to the fall, there was all sorts of hype, Jim, all sorts of hype. Well, just last week, about how the Fed was going to raise rates. And you listen to the media, and you listen to the mainstream media, and you turn on, pick your favorite television news station, and it's always about when the Fed's going to raise rates, when the Fed's going to raise rates. Well, we've never been a big believer that the Fed had any justification to raise rates based on its mandates, not based off of what I would like or what I think is right, but based off of its own self-prescribed mandates that they would have the ability to raise rates. And after today's data, it's starting to dawn on even some of the most fervent rate bull in the U.S. that the Fed is probably not going to be able to raise rates unless it wants to risk throwing the U.S. in recession. We had services purchasing managers survey come in much weaker than expected, and rate bulls tend to point to the service sector as propping up the U.S. economy. They've thrown in the towel on the manufacturing side, but they'll argue that doesn't matter. I would disagree, but in any event, the services side is weakening. The Fed's own indicators of the employment market was negative again this month, so it went positive in July. That allowed Janet Yellen to get up and say that she thought interest rates could rise. I mean, she, in less than 2 weeks, in a 2-week period, 2 weeks ago, she was saying how she thought the economy was strong enough that the rates could go up. Well, how do you square that against a backdrop where you've got the services sector on its heels and you've got the Fed's own labor market conditions index into negative territory? The Fed's not going to be able to raise rates anytime soon. They would need almost a miraculous turnaround in the economy to raise them in December. And look, personally, I'm all in favor of raising rates to get everything back to normal. And I think the Fed wants to get back to normal, but it's got its own mandates, and under its mandates, it cannot. We keep hearing about the strong employment growth, and I keep hearing about this from the Keynesian crowd all the time, that it's only a matter of time before inflation is going to hit the system, because we have full employment in the United States, and oh boy, that's just going to push up inflation so high. Well, you know what, Jim? If you calculated inflation in the U.S. the same way they calculate it in Europe, the U.S. inflation would not only be lower than Eurozone inflation, U.S. inflation would be zero. Not 2%, which is the Fed's target, zero. So this whole narrative about it's only a matter of time before the Fed raises rates, I think, is starting to come undone. That should support gold. Then the other side of the equation is, okay, we have a low inflation environment, a poorly performing economy. What happens to the bond market? Does it continue to rally? Do rates continue to go down? Or do we get a Donald Trump who's going to refit every airport in America? Or we get a Hillary Clinton who's going to start handing out free college tuition to students? Do we get a politician in the U.S. who starts opening up the spending taps and putting a floor on U.S. interest rates? So that will be the big question that investors will have to be on the lookout for as we head into the November 8th election. And at this point, today we saw the bond market rally again and rates came back down. But when you look at the campaign promises of both presidential candidates, let's just see what happens around November the 8th, and we'll see. If Trump were to win, and I still think he can win, and you had and the Republicans kept control of the House of Representatives, well, then you have an almost surefire formula for increased defense spending and infrastructure spending. Conversely, if the Democrats swept polls and the election, you would have a wide open agenda for Hillary to deliver on some of the expectations of the left in the Democratic Party. So we could be in for a big sea change. I don't think investors are prepared for it, and certainly I don't think institutional investors are prepared for it. They're still vastly underweight the gold market, gold stocks. And you could see at some point even a rush into gold stocks, and this could catch a lot of people by surprise. I wouldn't recommend anyone chase gold stocks at this point. Insiders, they were selling over the summer into weakness, but we're now heading towards a stronger period seasonally for gold. Insider selling in the senior producers is backed off, and in the junior miners, we still see bullish insider sentiment, but insiders always like to buy on a pullback. They like to buy when some data point comes up, and you'll get the rate permabulls back on TV saying the Fed's going to raise rates, and this is going to be the end for the gold market. Well, I'll tell you what, if the Fed raises rates, gold's going to go up $100 that day, because it'll just guarantee that it's the last time they ever raise rates, at least for the next few years.
We'll have more with Ted Dixon right after the break.
GEM International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. GEM International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Welcome back. We're speaking with Ted Dixon. Ted, Trump seems to be quite a bit of a protectionist. He says, sure, you can build the XL pipeline, but I'll negotiate a better deal. He wants to renegotiate NAFTA. If he kicks out hundreds of thousands or tens of millions of illegal immigrants, people have told me that would cause a huge shock to the U.S. economy and create even more unemployment.
Well, I think Donald Trump is, first and foremost, a pragmatist of the moment, and we'll have to see once he gets if he wins the election, if he were to be in a position, he's going to be an awfully busy camper, because he's promised to do a lot of very revolutionary type initiatives. So we'll have to see where he focuses and where he puts his priorities. But I wouldn't even marching down to the election, I really don't think you would want to overweight anything that Donald Trump says in terms of policy. I think you have a sense that he's going to be a tough negotiator on trade, but where he focuses will really, I think, depend on the flow of news and the flow of issues. We'll just have to see. He seems to be, along with most politicians, a bit of the flavor of the moment type of ice cream vendor, and we'll just have to see what flavor is on special if he wins. And will he be focusing on immigration as his big initiative once he gets elected, or will it be dealing with China or Mexico? One has to think he's going to be focused on the wall. That he's talked about it for a long time, and I suspect dealing with that will keep him quite busy for the first few months in power, if he were to win.
How would Mexico pay for a $30 billion wall?
I think they would do it by cutting some sort of a deal with the U.S. where they end up paying for something else worth $30 billion. I mean, I don't know. I mean, we just have to see how that all works out. But it's a two-way street on the Mexican border. There's a lot of things that the Mexicans, I'm sure, would like to keep out from the American side coming in, notably firearms. So it is a two-way street, and we would have to see how that played out. I don't think that it would be a game changer in terms of the markets. I think that it would be, though, if anything, a bit of a distraction for the new administration as they get bogged down in trying to get that sort of trophy initiative accomplished.
Bayer is bidding for Monsanto again, upping their bid to $65 billion, mixing pharmaceuticals and chemicals. A good idea?
Well, I think it goes to show you how scarce growth opportunities are across different sectors. When you have that kind of a deal being contemplated, we really are in a tough environment to uncover opportunities. And this is, again, why it's going to be very hard for the Federal Reserve to raise rates. We've propped up the global economy through these artificial rates for so long. We're kind of stuck with them until markets clear a little bit more. We're going to be faced with these kind of remarkable merger headlines, and I don't really see that as a particularly encouraging sign for global growth. I'd much rather see breakthroughs on technology, or big surprises in terms of new orders for large industrial companies. So when you get down to sort of having to merge your way into earnings per share growth, then it's not all that exciting.
Well, it looks like General Electric thinks 3D is going to be a big deal because they bought two 3D companies for $1.4 billion.
Right. So, you do have pockets of innovation. So that's positive. We'd like to see more, and hopefully, that will continue. Certainly, though, in terms of the Canadian market right now, the opportunities at the stock level are, from our perspective, tend to be located in both the sort of the mining area, because was hit so hard and so out of favor, but also in the technology area. And there are a lot of little companies in Canada that could surprise, but these companies are small. They're well suited for individual investors or small hedge funds that can do the work, do the homework, and find out the opportunities versus the companies that are unlikely to make it. U.S., you have a broader universe, but the opportunities that we see in the U.S. market are limited as well, compared to historically, given how exciting U.S. innovation has been coming out of Silicon Valley and other parts of the United States. So the pool of potential home runs in the public markets just it's disappointing at this point. So hopefully that will change. But so much, Jim, has been focused on share buybacks and engineering earnings per share that, real risk taking, getting down, you're starting your own business in the U.S. I don't have the statistics, but certainly if you're a 10-year corporate high flyer in an organization, with an MBA, you've looked at the market activity in the past 10 years, and you see your best potential is to work your way up to the CEO suite, engineering your way through, repurchasing shares and trying to get as many stock options as possible. You're not probably thinking about venturing it on your own, mortgaging your house, and setting up your own company. When you think, well, I'll just stay put, and we can shrink the company to get rich, and that's what's happening in the United States right now, and to a lesser degree Canada as well.
Ted, thank you so much for chatting with us.
It's great to be here. Thanks, Jim.
My guest has been Ted Dixon, CEO and co-founder of InkResearch.ca. You're listening to HowStreet.com radio. You can find us on Twitter at TalkDigitalNet. Check out our YouTube channel, Talk Digital Network. Questions for the show can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.